I was thinking about the Genius Act that President Trump just got done signing into law, which deals with stable coins and creating the first piece of real crypto legislation for the United States in the United States' attempt to be the leader in crypto worldwide. And I thought about it because it was like there is a connection between interest rates, debt, stable coins, and crypto. And what stable coins are basically dollar equivalents, digital dollar equivalents. Basically, I need a way of representing if I have $1 million in the bank right now, but I want to be able to utilize crypto infrastructure. So instead of having to have $1 million and then deposit that $1 million into a centralized exchange like Coinbase or Gemini or any of the other centralized exchanges, and then purchase my crypto, I now can say, hey, I will create a stable coin that is 100% backed by either US dollars or backed by T-bills, Treasury bills, that on a one-to-one basis. So if I say that I have $1 of this particular stable coin, then let's call it, use one of the examples, Circle, right? USDC. If I want to say that I have $1 of USDC, then I need to have $1 of actual US currency or $1 of treasury bills in the bank, because it has to be backed one to one. So for every digital dollar, for every stable coin that I issue, it needs to be backed by $1 as well. Well, stable coins make it easier so that you can make crypto to crypto transactions. Stable coins are crypto native assets and therefore allow for you to trade crypto a lot easier. Now, the biggest stable coin market right now is with Ethereum, the largest by far. The two largest issuers of stable coins is Circle and Tether. Circle is USDC, Tether is USDT. And those have the widest range of markets that are available, meaning that I can trade USDC or USDT for Bitcoin, for Ethereum, for what else? Bitcoin, H bar. There's markets basically for converting those stable coins to almost any crypto that you want. The reason why that's important is because now I, as a stablecoin issuer, I may not have dollars in the bank, but wait, somebody else might have treasury bills. Basically what it does is it creates a better market for treasury bills. And treasury bills allow, when people buy treasury bills, it allows for the United States to issue more dollars because our debt is acting as currency. So when you have lower interest rates, people are more interested in buying our debt. Things flow out more easily, and now you're also able to bring more capital in. So if a stablecoin issuer is required to either have dollars on hand or T-bills on hand, now they're also going to be incentivized to buy more T-bills. Then you have T-bills on your balance sheet. Guess what that allows for the United States government to say? Look, hey, we have more demand for our debt. Let us issue some more debt, which brings in more money supply. And as a result, with more money supply, it seems like everybody else has gotten richer. When interest rates get lower, asset prices usually go higher. What does that mean? That means it seems like when you have lower interest rates, stocks rise and crypto rises. So now that we've allowed for more stablecoin issuers to enter into the market, we've created a regulatory framework for that. What happens when, see, I was around when the total crypto market was $100 billion. It's now up to 2 trillion, 2, 3, 4 trillion, however much it is right now. I don't really watch that now. What happens when $10 trillion worth of assets all around the world now have easier rails of investing? That's the future that we're looking at now with the Genius Act.